Fixed-rate mortgage. A fixed-rate mortgage is the most traditional and widely used type of home loan where the interest rate stays the same for the entire life of the loan, whether that is 15, 20, or 30 years. Because the rate never changes, the monthly principal and interest payment remains predictable and stable over time. This structure became especially popular after the Great Depression, when long-term housing stability became a priority. It matters because homeowners are protected from rising interest rates and can plan their finances with confidence. Adjustable rate mortgage. An adjustable rate mortgage, often called an ARM, begins with the fixed interest rate for a short introductory period and then adjusts periodically based on market conditions. After that initial phase, the rate resets according to a benchmark index plus a lender's margin, which means payments can rise or fall over time. ARMs became more common during periods of high interest rates because they offered lower starting payments. They can be useful for buyers who plan to move or refinance early, but they also carry the risk of higher costs later. Interest-only mortgage. An interest-only mortgage allows the borrower to pay only the interest for a set number of years at the beginning of the loan. During this time, the loan balance does not decrease because no principal is being paid. Once the interest-only period ends, monthly payments increase since the borrower must start repaying the principal. These loans gained popularity during housing booms when buyers wanted lower initial payments. They offer short-term flexibility but require careful planning to handle the later payment increase. FHA loan. An FHA loan is a mortgage insured by the Federal Housing Administration and was created in the 1930s to expand homeownership opportunities. It allows borrowers to qualify with lower credit scores and smaller down payments compared to many conventional loans. Because the government provides insurance, lenders are more willing to approve applicants with limited financial history. Borrowers must pay mortgage insurance premiums, which increases total cost. The program makes homeownership accessible to many first-time buyers. VA loan. A VA loan is backed by the U.S. Department of Veterans Affairs and is available to eligible service members, veterans, and certain military spouses. Introduced after World War II, it was designed to help returning soldiers purchase homes. One of its strongest benefits is the possibility of buying a home with no down payment. It also does not require private mortgage insurance in most cases. Government backing reduces lender risk, which often results in favorable terms for qualified borrowers. USDA loan. A USDA loan is guaranteed by the United States Department of Agriculture and focuses on supporting homeownership in eligible rural and suburban areas. The program encourages development outside major urban centers and strengthens smaller communities. Qualified borrowers may purchase a home with no down payment if they meet income and location requirements. It plays an important role in expanding housing access in less densely populated regions. Jumbo loan. A jumbo loan is a mortgage that exceeds the conforming loan limits set by the Federal Housing Finance Agency. Because the loan amount is higher, lenders take on more risk and usually require stronger credit profiles and larger down payments. These loans are common in high-cost real estate markets where property values exceed conventional limits. They allow buyers to finance more expensive homes that standard loans cannot cover. Balloon mortgage. A balloon mortgage offers relatively low monthly payments for a fixed period, followed by one large payment at the end of the term. That final payment covers the remaining balance in full, rather than spreading it out over many years. Borrowers often plan to refinance or sell the property before the balloon payment becomes due. While the structure can lower short-term costs, it depends heavily on future financial conditions. Reverse mortgage. A reverse mortgage allows homeowners, typically older adults, to convert part of their home equity into cash without selling the property. Instead of making monthly payments to a lender, the lender provides payments to the homeowner in a lump sum, installments, or a credit line. The loan is usually repaid when the homeowner sells the house, moves out permanently, or passes away. In the United States, many reverse mortgages are insured by the Federal Housing Administration under a program designed for seniors. It provides retirement flexibility while gradually reducing home equity. Conventional loan. A conventional loan is any mortgage that is not backed by a government agency and instead follows guidelines set by private lenders. Borrowers generally need solid credit, stable income, and a reasonable down payment to qualify. If the down payment is below a certain threshold, private mortgage insurance is typically required to protect the lender. Conventional loans remain the backbone of the housing market and offer competitive rates for financially qualified buyers.